$100 silver is now spreading across the world, not everywhere at once, not on every screen, but quietly, relentlessly. In country after country, the number has already been crossed, not because silver suddenly became rare overnight, but because currencies quietly became weaker than anyone wants to admit. Warehouses are emptying, premiums are rising, institutions are watching, not speaking. And the people who still believe this is just another cycle are about to discover what happens when money no longer buys what it used to. Because the real question isn't whether silver reached $100. The real question is, what happens after the world realizes it's already too late? Welcome to Boring Currency Index. This channel isn't for hype. It's for people who've lived long enough to see promises break. For people who remember when money actually meant something. If you're one of those people, if you don't need excitement, only truth, consider subscribing, not for today's video, but for the ones you'll wish you'd watched earlier. And before we continue, tell us something important. From where in the world are you watching this? Because what's happening to silver is not happening in just one place. $100 silver is now spreading across the world, not as a headline, not as a sudden shock, but as a quiet signal moving through markets that most people are not trained to see. In several countries, the effective price of silver has already crossed that level. When local currencies are converted, when premiums are added, and when delivery costs are included, businesses are already paying the equivalent of $100 or more for a single ounce. This is not happening in one isolated market. It is happening across regions, currencies, and supply chains. The reason this matters is simple. Silver is not just an investment asset. It is an industrial input. It is used in electronics, energy systems, medical equipment, and manufacturing processes that modern economies depend on. When the price of silver rises globally, it sends a message far beyond financial markets. It tells producers, suppliers, and decision makers that something deeper is changing. Most observers focus on the quoted spot price, usually measured in US dollars. That approach misses the real story. Businesses do not operate at spot prices. They operate at delivered prices. They care about what it costs to actually secure material, not what a screen says in a financial center thousands of miles away. When silver trades near $100 after currency conversion and premiums, the metal itself has not suddenly changed. The currency used to price it has. This distinction is critical. Silver is doing what hard assets have always done in periods of monetary stress. It is revealing the declining purchasing power of money. For decades, currencies were treated as stable measuring tools. $1, €1, €1 were assumed to hold relatively consistent value over time. That assumption allowed businesses to plan, price, and invest with confidence. That world is fading. The spread of $100 silver across the globe is evidence of that shift. In some countries, the adjustment has been faster. In others, it has been slower, but the direction is the same. When measured against silver, currencies are losing ground. This is why the price signal appears uneven. It is not silver moving differently in each place. It is currencies weakening at different speeds. For business leaders, this matters more than any forecast. When input costs rise, because currency buys less metal, margins compress. When margins compress, pricing power is tested. When pricing power breaks, balance sheets suffer. This is how currency issues quietly become corporate problems. Many still dismiss the move in silver as speculative. They assume demand is being driven by traders chasing momentum. That explanation does not hold up under scrutiny. Speculation can move prices short-term, but it cannot sustain global premiums, drain inventories, and alter procurement behavior at the same time. What is happening instead is adjustment. Market participants are responding to reality. They are reacting to years of monetary expansion, rising debt, and declining confidence in paper promises. Silver is not leading this change. It is reflecting it. There's another reason silver matters at this stage. Unlike gold, silver is consumed. Once it is used in industrial applications, much of it cannot be economically recovered. This means supply is not just limited, it is permanently reduced over time. When demand rises in a system like that, price becomes the only balancing mechanism. As $100 silver spreads across the world, it forces difficult questions. How should businesses price products when currency value is unstable? How should contracts be written when input costs can reprice rapidly? How should capital be allocated when traditional assumptions no longer hold? These are not theoretical concerns. They are already appearing in boardrooms, procurement meetings, and risk committees. Companies that rely on silver directly feel the pressure first. Others feel it later through higher costs, supply disruptions, and financial volatility. The most important insight is this. The rise of silver is not a story about metals. It is a story about money. When a single ounce of silver requires nearly $100, it is not the metal that has become extreme. It is the unit of account that has become smaller. This is why the spread of $100 silver should not be ignored. It is a global price signal telling businesses that the monetary environment has shifted. Those who understand this early can adapt. They can hedge, restructure, and plan. Those who ignore it will be forced to react later, often at a much higher cost. And this is only the beginning, because once a price signal like this appears across multiple regions, it rarely reverses quietly. It either stabilizes at a higher level or it accelerates. The next phase depends not on sentiment, but on trust. Trust in institutions, trust in currencies, and trust in the systems that price the modern world. Markets do not wait for official statements. They do not wait for investigations to end or reports to be published. They move when trust begins to crack. This is the environment in which silver has started to behave differently. In recent months, pressure on central banking institutions has increased. Legal challenges, political scrutiny, and public questioning of monetary decisions have all entered the open. For decades, these institutions operated with near total confidence. Their credibility was assumed. Their authority was rarely challenged. That assumption is no longer universal. When legal pressure touches a central bank, markets do not debate technical details. They focus on one issue only: credibility. Can the institution that manages currency still be trusted to protect its value? Once that question appears, even quietly, capital begins to reposition. This is where silver enters the picture again, not as a speculative bet, but as a response to uncertainty. Investors, institutions, and businesses do not move into hard assets because they expect excitement. They move because they see risk where stability once existed. Confidence is the foundation of modern financial systems. Bonds rely on it. Currencies rely on it. Entire balance sheets rely on it. When confidence weakens, even slightly, money looks for alternatives. It moves away from promises and toward things that do not depend on policy decisions. Silver's recent behavior shows this clearly. Price movements have not been smooth or emotional. They have been directional. They have followed moments of institutional stress, not social media trends. This pattern tells an important story. Gold often reacts first when fear rises. It is the traditional store of value. Silver behaves differently. It tends to move when concern spreads beyond fear and into structure. When people begin to question how systems function, not just whether markets will fall, silver starts to lead. This is because silver sits at the intersection of finance and the real economy. It is both money and material. When confidence weakens, silver absorbs pressure from both sides at once. Investors want protection. Industries still need supply. The result is tension that shows up in price. Many still believe central banks can simply restore confidence through communication. History suggests otherwise. Once trust is damaged, words lose power. Markets demand proof. They demand restraint, consistency, and time. None of those are easy to deliver in a world of rising debt and political pressure. As trust weakens, capital flows change direction. Money leaves long-duration assets that depend on stable purchasing power. It reduces exposure to bonds that promise fixed returns in uncertain currency terms. It looks for assets that cannot be adjusted by policy. Silver fits that role better than many realize. It cannot be printed. It cannot be redefined. It cannot be diluted. Its supply responds slowly, and its demand does not disappear when confidence fades. This makes it sensitive to changes in trust. What matters most is not the price level itself. It is the behavior around it. When silver approaches $100 and holds near that range, it signals that the market is no longer treating the move as temporary. It is beginning to accept a new baseline. This acceptance changes behavior. Businesses become more cautious with long-term contracts. Institutions reassess risk models built on old assumptions. Portfolio managers revisit allocations that once excluded hard assets entirely. These shifts are not announced publicly. They happen quietly. Committees meet. Models are adjusted. Scenarios are updated. Capital is repositioned gradually at first, then more decisively. The mistake many make is assuming this process is driven by fear. It is not. It is driven by math. When currencies lose purchasing power faster than expected, holding them becomes a liability. When real assets preserve value, holding them becomes a responsibility. Silver's rise is not a vote against one country or one policy. It is a vote against instability itself. It reflects a global system under strain where trust is no longer evenly distributed. For business leaders, this creates a new challenge. Decisions can no longer rely solely on historical stability. They must account for credibility risk. They must consider what happens when monetary anchors shift. This is why silver matters at this stage of the cycle. It is not signaling panic. It is signaling transition, a move from blind trust to cautious verification, from assumption to evidence. And once markets begin to price credibility instead of promises, they rarely go back quickly. The adjustment may pause, it may slow, but the direction tends to remain intact. The question is not whether confidence can be managed in the short term. The question is whether it can be restored at scale. Until that answer becomes clear, assets like silver will continue to reflect the doubt that currencies cannot hide. This sets the stage for the next issue markets must confront. Trust loss alone does not drive price indefinitely. Structure does. And the structure of the silver market is under far more strain than most realize. For years, most people believed the silver market was simple. A price appeared on a screen, trades occurred, and supply adjusted when needed. That belief depended on one assumption, that the paper market and the physical market remain tightly connected. That connection is now weakening. Silver trades in two different worlds at the same time. One is digital. Contracts are bought and sold, often with leverage, and most positions are closed without metal ever changing hands. The other world is physical. In that world, silver must exist, be stored, transported, and delivered. These two systems are meant to balance each other. Today, they are drifting apart. The first sign of this separation is not price, it is availability. When physical silver becomes harder to secure, the stress does not immediately appear on trading screens. It appears in vault reports, delivery timelines, and premiums. Those signals are now flashing across multiple regions. Registered inventories play a critical role in this system. They represent silver that is approved for delivery against futures contracts. This metal is the backbone of market credibility. Without it, paper promises lose meaning. In recent months, large volumes of registered silver have disappeared from major vault systems. Not transferred, not reclassified, removed. This matters because registered inventory is not excess supply. It is functional supply. It is the metal that allows exchanges to operate smoothly. When it shrinks while prices rise, it sends a clear message. Someone is demanding delivery, and they are not doing it casually. At the same time, premiums are rising. A premium is the amount paid above the official price to obtain real metal. When premiums remain low, it suggests supply is sufficient and delivery is easy. When premiums rise across multiple regions, it signals strain. In several markets, buyers are paying double-digit premiums consistently, not during emergencies, not during brief shortages, persistently. This indicates a loss of confidence in paper pricing. Buyers are willing to pay more to ensure possession rather than rely on promises. The reason this matters is that premiums reflect the true market balance. They are not controlled by financial narratives. They are set by availability. When premiums rise while futures prices remain relatively calm, it means the physical market is tightening faster than the paper market can acknowledge. Silver's unique nature amplifies this effect. Unlike gold, much of silver is consumed. It is used in electronics, energy infrastructure, medical devices, and industrial systems. Once embedded, it is rarely recovered. Each year, more silver leaves the tradable system permanently. This creates a structural problem. Demand continues, but supply does not replenish quickly. New mines take many years to develop. Recycling has limits. Stockpiles shrink. When inventories fall below critical levels, the market cannot respond smoothly. Lease rates provide another warning signal. These rates represent the cost of borrowing physical silver. When lease rates rise, it means demand for metal is increasing relative to available supply. In key financial centers, lease rates have spiked. This suggests the system is struggling to source metal for short-term needs. Higher lease rates disrupt arbitrage. Arbitrage is the mechanism that keeps paper and physical prices aligned. When it breaks down, price discovery becomes unreliable. The paper market can no longer reflect physical reality accurately. This is how market stress builds quietly. There is no single event, no dramatic announcement, just increasing friction. Longer delivery times, higher premiums, rising borrowing costs. Gradually, participants realize that access to metal is no longer guaranteed. For businesses, this creates operational risk. Contracts based on spot prices may no longer secure material. Hedging strategies may fail if delivery cannot be obtained. Supply chains become vulnerable in ways that models did not predict. For investors, it creates a distinction that many ignored. Exposure is not ownership. Holding a contract is not the same as holding metal. When the system is functioning normally, the difference seems irrelevant. When stress appears, it becomes decisive. The spread of $100 silver around the world cannot be understood without this context. Price is rising not because demand is emotional, but because the physical system is under strain. The market is being forced to ration access through higher costs. This is not a temporary imbalance. It is the result of years of underinvestment, rising industrial reliance, and growing distrust in paper systems. Once inventories fall below certain thresholds, recovery is slow and difficult. As the physical market tightens, behavior changes. Buyers move earlier, sellers hesitate, institutions reassess risk, the system becomes less flexible, more fragile. This sets up a critical phase. When physical constraints collide with rising institutional interest, price does not move smoothly, it jumps. And once that process begins, it is difficult to reverse. The silver market is approaching that point, and the signals are no longer subtle. They are simply ignored by those still focused on screens rather than supply. Institutional capital does not behave like individual investors. It does not chase headlines, and it does not react emotionally to price swings. It moves according to mandates, risk models, and long-term obligations. When institutions begin to pay attention to an asset, it signals that something structural has changed. For many years, silver sat outside institutional portfolios. It was viewed as too volatile, too small, or too speculative. That perception was based on a stable monetary backdrop, where currencies held purchasing power and traditional assets behaved as expected. That backdrop is no longer reliable. As currency stability weakens, institutions are forced to reconsider old assumptions. Pension funds, insurance companies, sovereign funds, and corporate treasuries all face the same problem. They must protect purchasing power over long periods. When money loses value, holding it becomes a risk, not a safety measure. This is where silver begins to re-enter the discussion, not as a trade, but as a structural asset. Institutions do not ask whether silver will rise next month. They ask whether their portfolios can function in an environment where currencies steadily buy less. The scale of institutional capital matters. A small allocation decision at the institutional level represents enormous volume. Even a 1 or 2% shift can equal hundreds of millions of dollars. In a market where physical supply is already tight, that scale creates pressure immediately. Unlike retail buyers, institutions do not accumulate slowly. Once approval is granted, capital is deployed efficiently. Positions are established in size. This is why institutional entry rarely produces gradual price appreciation. It produces gaps. This dynamic is especially dangerous for silver because the physical market is limited. Registered inventories are already shrinking. Industrial demand continues. Recycling cannot scale quickly. When large buyers arrive, there is no buffer. At this stage, price stops acting as a negotiation. It becomes a rationing tool. Those who need silver must pay whatever is required to secure it. Those who hesitate may find it unavailable regardless of price. Institutional behavior also affects psychology. Once a major allocator enters the market, others are forced to respond, not because they suddenly agree on fundamentals, but because underperformance becomes unacceptable. This creates feedback loops that accelerate reallocation. This is how regime shifts unfold. Quietly at first, then suddenly. Old correlations break, assets that were ignored become essential, traditional hedges fail, new baselines form. For business leaders, this creates a strategic challenge. Decisions must be made before consensus forms. Waiting for confirmation often means paying higher costs later, but moving early requires understanding, not excitement. Silver's role in this environment is clear. It is not a bet on crisis. It is protection against erosion. If the financial system stabilizes, silver retains value. If instability increases, silver preserves purchasing power when many assets do not. That asymmetry is what attracts serious capital. Policy responses may attempt to slow this process. Governments can adjust regulations, release reserves, or alter market rules. History shows these actions can delay repricing, but they do not eliminate underlying drivers. Scarcity, demand, and debasement remain. The global nature of the silver market limits the effectiveness of intervention. Metal can move across borders. Jurisdictions compete, capital adapts. This makes long-term suppression difficult. As $100 silver spreads across the world, the issue is no longer prediction. It is positioning. Those who understand the mechanics recognize that opportunity does not remain open indefinitely. Once institutions commit, access tightens rapidly. The final decision facing businesses and allocators is simple but uncomfortable. Act while choice exists, or wait until choice is removed. History suggests most wait. They move when pressure is visible, when narratives are clear, when prices are already higher. By then, the repricing is no longer a warning. It is a reality. And in that reality, the question is not how high silver went, but how much purchasing power was lost by those who assumed the old system would hold. $100 silver is not the end of the story. It is the signal that the next chapter has already begun.